A Google tax goes. India is set to remove the 6% equalisation levy, commonly referred to as the Google tax on online advertising services provided by foreign tech companies like Google and Meta. This will be from April 1st. This decision is part of amendments to the Finance Bill 2025 and is obviously aimed at improving trade relations and helping in the negotiations on between India and the United States, according to Reuters. The levy, introduced in 2016, taxed payments made by Indian businesses to foreign companies for digital advertising. The elimination of that tax comes as part of India's efforts to mitigate trade tensions with the United States, which we just referred to, which had, by the way, previously criticized that levy and threatened retaliatory tariffs on Indian exports. The removal is expected to benefit tech giants, reducing advertising costs and improving their profit margins. At one level, the gesture is obviously seen as an attempt to prevent further trade disputes, but at another level, the money collected from this tax may not have been that much. There could, of course, be other taxes to balance this out. I reached out to Himanshu Parekh, partner and head of Tax West at KPMG Assurance and Consulting, and I began by asking him the impact of this move.
Let me give you a little background and context to this Google tax, as we call it, right? So historically, if we see the law in India when it comes to taxation of foreign companies, what the law says is that in a case where a foreign company either has a taxable presence in India or typically if it earns income by way of royalty or fee for technical services, then it becomes liable to tax in India. Now, what we had witnessed over a period of time is that owing to the digitization of the world, we had several new foreign companies starting to earn revenues from online sale of goods or online provision of services without them having to set up a taxable presence in the market jurisdiction. What we mean by market jurisdiction is a country from which they earn revenues. So you have a foreign company setting up an e-commerce platform through which it sells goods or provides services and earns revenues through that. So take the case of Amazon, Google, Facebook, you name it. And all these foreign companies were able to earn revenues from the market jurisdictions without setting up a taxable presence in the form of a branch or an office or a factory, etc., in the source country or the market jurisdiction. And hence, as per the global international tax norms, they were not liable to pay any income tax in the jurisdictions from where they earned revenues. And therefore, this became a global issue at one point in time. You had several large US MNCs not only earning such revenues from India, but from several other jurisdictions, particularly in Europe. And this became a big issue at a global level as to how should countries tax this income being earned by these US MNCs. And while discussions were on globally as to what is the solution to this issue, in the meanwhile, what India did was, India introduced a new tax, a new form of digital services tax, what we call as equalisation levy. The tax got introduced for the first time in the year 2016, whereby we said we will impose a 6% tax on any revenues being earned by a foreign company from online placement of advertisements. Thereafter, in the year 2020, we significantly expanded the scope of equalisation levy so as to cover within its purview any other category of transaction undertaken online, resulting in an online sale of goods or online provision of services. That happened in the year 2020, but the rate of tax which was fixed for that category of transactions was 2%. So we had a 6% equalisation levy for revenues from online placement of advertisements, and we had a 2% levy for all other categories of online transactions. Apart from India, we saw the proliferation of this digital services tax being levied by several other countries, primarily European countries. And when this started happening, there was a significant pushback which came from USA to the global fraternity to say that we need to find a global solution to this issue. As US MNCs, we are not going to have US MNCs suffer and pay this huge amount of tax in every country. And therefore, an exercise was undertaken to find a global solution on the subject matter. That exercise is still underway. As things stand today, that global solution has not yet been found or not yet been at least implemented. In the meanwhile, what happened is India sort of came to the conclusion that it wants to be a party to this global solution as and when it is derived or evolved. And therefore, in its wisdom, India decided to withdraw the 2% equalization levy in the last budget, the budget of 2024. And what we've now seen is the 6% equalization levy, which is applicable on online placement of advertisements, that has been withdrawn in the current budget. So India wanted to send out a strong signal to USA to say that whatever global solution is found on the issue, we will be a party to that global solution. In the meanwhile, we are withdrawing this unilateral tax, what we call as equalization. So that's the entire background of this issue.
What's the quantum like in your understanding or estimation that could be hit by this?
While the revenues are not in public domain, basis whatever news reports we've seen in the past, what India was managing to collect by way of equalization levy was short of 5,000 crores annually. So not a significant amount when you look at the overall tax revenue collection for the country as a whole, and we have a budget of whatever 20 lakh plus crores only on income tax. 5,000 crores out of 20 lakh odd crores is a pretty insignificant amount. And therefore, in the interest of bilateral trade relations with various countries, especially with USA, I think it made better sense for India to withdraw this.
So just to come back to someone who may not understand, now Google or Meta or Amazon, they also have India entities who are doing business in India who pay taxes. How is that different, and why is that not the main business entity as opposed to what you're saying on advertising or online advertising, which is earning revenue internationally?
So very good question. And typically the way it works is that wherever these US multinationals have set up entities in India, they act as their distributors of the services, or they act as their marketing arms. And the Indian entities are therefore compensated, basis whatever functions they perform in India, which is merely a distribution activity or the marketing activity, for which the compensation being paid to them is a pretty insignificant portion of the overall revenue which is earned by the overseas MNC. So let's say it earns 100, it may just pay a small compensation of maybe 4, 5, 6, 10, whatever it is, depending on the functions carried out in India. But the bulk of the revenue, that it goes untaxed.
If I were to now look at the 2025 finance bill, which is now gone, is there anything else that has happened apart from this removal of the 6% equalization levy?
There are a few other amendments going, but they are all very small and minor amendments, something ancillary in nature, nothing very substantive. Some clarificatory amendments in the context of International Financial Services Center, IFSC, in the context of foreign funds, what could be the rules and regulations applicable to them. Some very, very minor things. And I would not say there are any substantive changes in the bill.
Another way of asking that question is, any surprises that we did not know about or we should know about?
Not really. The withdrawal of equalization levy, the 6% equalization levy, was a big surprise. And that's a very welcome surprise, I'd say. That was a big one.
Right, Himanshu. Thank you so much for joining me.
Thank you, Govind. See you then.